Salute, folks. It's your boy, the insurance junkie, your fiduciary fella, the all-star advisor Alonzo, your social media insurance broker and registered financial consultant. Back again today to wipe and tap on your head with yet another ADH Wealth Solutions article. Today is from thestreet.com, and it's an article entitled Fidelity says $1 million won't save your retirement. As usual, I'm going to read the article that it takes some time for me to find and add my personal touch to it. Without further ado, make sure you hit that like, drop a comment, subscribe, and hit that notification bell so you're made aware every time I release new content. And as always, share. So, Fidelity's research reveals their retirement number most Americans chase. For decades, $1 million has been the golden benchmark for retirement security across the United States. Reaching seven figures feels like crossing a finish line that guarantees you can finally stop working and relax. Hence why we have what we call the 4% safe harbor rule, meaning if you have that $1 million, you're supposedly supposed to be able to live off of 4% or $40,000 a year for about 20 years without running out of anything. But let's continue reading and see what that says. However, Fidelity Investments' 2026 State of Retirement Planning Study reveals that $1 million is neither a guaranteed safe harbor nor a universal goal for retirees. Respondents in Fidelity's survey said they expect to need approximately $1.4 million to retire comfortably on their terms. Retirees, however, report having closer to $490,000 in savings when they leave the workforce for good. So, about a third of what they say they need is what they have in reality. That gap between expectations and reality should make every working American stop and reconsider what retirement readiness truly looks like. The real story here is not about whether $1 million is too much or too little for your retirement. It's about why a single number cannot define your financial future and what Fidelity says you should focus on. Fidelity's research exposes the flaws in chasing a single retirement number. Kenny Davin, a CFP and vice president of Fidelity's Fort Lauderdale branch, summarized the core problem in blunt terms. Some people can make $1 million last an entire retirement, while others burn through $3 to $5 million and still run short. The difference comes down to spending habits, family obligations, and whether your lifestyle matches your savings, according to Fidelity. Your retirement age, whether you carry a mortgage into your 60s, and what your healthcare costs look like, all shape whether $1 million gets you through. So here's the thing, ladies and gentlemen. You're also going to realize that if you can currently contribute, let's say maxing your 401k or these mega backdoor Roths that everybody talks about, you're living substantially above, let's say, a $40,000 annual lifestyle. So when they talk about your lifestyle, you have to realize there's multiple stages of retirement. There's the go-go, slow-go, and no-go. Go-go is like when you graduate high school and go to college for the first time. You go crazy. Slow-go is when you're a sophomore or junior in college and you're used to things. And then the no-go is when you're a senior and you're, really ready to graduate. And so you're hunkering down, you're not partying and doing dumb things anymore. Some people absolutely can make $1 million last. Others with $3 to $5 million still struggle because they spend heavily or have significant obligations, such as supporting family members. It's all about the specifics, Kenny Davin says. Most Americans plan to retire around age 62, but nearly 1 in 4 say they are unsure when they will stop working, Fidelity's survey found. That uncertainty about timing creates a downstream problem for everything from investment strategy to withdrawal planning. If you do not know when you will retire, you cannot know how long your savings will last. 5 risks that can drain a $1 million retirement faster than you expect. Fidelity identifies 5 specific threats that determine whether your retirement savings hold up or collapse under real-world conditions. Each one can independently derail a plan that looks solid on paper and together they compound the challenge. Again, this is stuff I say all the time, but sometimes people like to listen to the big name companies. Wealthy people generally aren't with the big name companies. 1. Longevity risks means your savings may need to last 30 years or more. Living into your 90s is increasingly common, which means a retirement portfolio needs to stretch across 3 decades or longer. $1,000,000 divided by 30 years gives you roughly $33,000 annually before investment returns, which is not enough for most households. 2. Inflation has shaped how retirees think about their purchasing power. More than a third of Americans, 37%, now say rising prices are one of the biggest challenges they face when preparing for retirement. For example, in Connecticut, gas is almost $6 a gallon. Years of elevated inflation have pushed everyday costs higher, meaning your savings buys you less each year you retire. Healthcare costs alone could consume a massive share of your nest egg. A 65-year-old retiring in 2025 may need $172,500 in after-tax savings just to cover healthcare and medical expenses throughout retirement. That figure does not include long-term care, which can add tens of thousands more depending on your situation. Your withdrawal rate determines whether your portfolio survives or not. Withdrawing 4% from a $1,000,000 portfolio gives you $40,000 per year, which may or may not be enough depending on other income. If you need more than that, you risk shortening the sustainability of your savings significantly. Investment allocation either supports or undermines your long-term security. Retirees who shift too heavily into conservative investments may lose the growth they needed to keep pace with inflation and longevity. Fidelity recommends covering essential expenses with guaranteed income sources like Social Security, pensions, or annuities, or life insurance, while keeping invested assets for discretionary spending. The 4% rule is a starting point, not a retirement guarantee. For roughly 30 years, millions of Americans have relied on the 4% withdrawal rule as their primary retirement spending strategy. You take 4% of your portfolio in year one, adjust for inflation each year after, and hope the math holds for 3 decades. Morningstar's latest State of Retirement Income report found that 3.9% is the highest safe starting withdrawal rate for new retirees. That assumes a balanced portfolio with 40% stocks, 60% bonds, and a 30-year time horizon, and a 90% probability of not running out. On a $1,000,000 portfolio, 3.9% withdrawal means you get $39,000 in year one, which is barely above what Social Security pays. To address this risk, Fidelity suggests that individuals planning for retirement consider more conservative withdrawal rates closer to 3%. While that approach reduces annual income, it can help preserve portfolio longevity and lower the risk of outliving one's savings. Social Security alone will not close your retirement income gap. The average monthly Social Security retirement benefit reached approximately $2,071 in January 2026, after the 2.8% COLA. That translates to roughly $24,852 per year, which covers less than half of what the average retired household spends, according to the Social Security Administration. The BLS puts average annual spending among retirees at about $60,000, resulting in a $35,000 shortfall. Your retirement savings, pension, or part-time income needs to fill that gap for every single year you are retired. Higher Medicare Part B premiums in 2026 also eat into that Social Security increase, reducing the net benefit bump for most retirees. The standard Part B premium increased about $21 per month, which wipes out more than a third of the $56 monthly COLA increase, AARP reports. Most Americans are nowhere near the benchmarks financial experts recommend, which is why a lot of these financial experts who are telling you to stay the course and invest are looking out for their retirement and not doing a fiduciary standard of looking out for you. It sounds nice, but it's nice in theory, not in practice. The median retirement savings for American households is just $87,000, a fraction of the $1 million target most people cite. Only about 5% of households with retirement accounts have $1 million or more saved, the Federal Reserve Survey of Consumer Finances shows. Financial experts generally recommend having 1 time your annual salary saved by age 30, 3 times by 40, 6 times by 50, and 10 times by 67. Workers aged 55 to 44 have median retirement savings of $185,000, which falls far short of even the most conservative guidelines. The savings gap by the numbers. The gap between average and median savings reveals how dramatically top earners skew the national numbers. Here are the key figures. Average retirement savings across all families is $333,940, while the median is just $87,000. About 54% of American households report having no dedicated retirement savings at all. Workers aged 55 to 64 have average savings of $537,560, but a median of only $185,000. Fidelity reported 665,000 401k millionaires in Q4 2025, mostly long-term consistent savers. These figures come from Federal Reserve's 2022 Survey of Consumer Finances and Fidelity's Q4 2025 retirement analysis. The takeaway is that most Americans need to accelerate their savings rate, not just hope to hit a magic number. Fidelity's 6-step framework to make your savings last regardless of the total. Fidelity's research goes beyond diagnosing the problem and lays out specific actions you can take now to strengthen your position. One, if you'll notice, they mentioned annuities, pensions, which are annuities. You can also do certain things like LIRPs, life insurance retirement plans. The firm emphasizes you do not need a perfect number to move forward, you need a framework. Separate your must-haves from your nice-to-haves. Segment your savings into emergency protection and growth buckets. Keep emergency savings liquid for unexpected expenses. Use insurance and income protection strategies to safeguard what you have built and maintain growth-oriented investments to help your money keep pace with inflation over time. Right-size your withdrawal strategy from the start. Begin conservatively and adjust as market conditions and your personal situation evolve over time during your retirement years. The right withdrawal rate depends on your timeline, market conditions, and other income sources and risk tolerance. Plan explicitly for healthcare costs before you retire. Price out Medicare options. Estimate out-of-pocket costs and consider long-term care coverage well ahead of your retirement date. 1 in 5 Americans has never even considered healthcare costs in retirement, Fidelity's research shows. Stress test your plan with realistic scenarios regularly. Run what-if projections that include cutting spending, delaying retirement, adding part-time income, or planning for higher-than-expected inflation. Among retirees who worry about running out of money, 69% cut spending and 32% look for additional work, Fidelity found. Automate your withdrawals and consider professional guidance. Some of the best savers become the most hesitant spenders because they fear drawing down on their accounts, Davin observed. Having automated withdrawals and a professional management strategy can help reduce anxiety or keep your plan on track. So that's it for today, folks. Make sure you hit that like, drop a comment, subscribe, and hit that notification bell so you're made aware every time I release new content. And as always, share. With that being said, wipe ass, work in progress every day and see success. And remember, folks, when people challenge you, they don't challenge you to challenge you, but they challenge you to challenge you. Accept the challenge. Salute.